I'm James Wagner for Professor It, and back as usual with a question. Wouldn't it be nice if we didn't have to pay income taxes? Now that's not a tough question to answer, but it always frustrates me about how many people are willing to pay more taxes than they need to. Think about how much more money we would have. Think about how much more money we would have to put into our savings and investment accounts. Think about how much more principal of compound returns could be working for us. Think about how much more financial security we would have. If you observe the practices of the very wealthy, you will find a near obsession with taking advantage of every single tax break available. After all, for most of us, taxes represent the biggest single expense in our life. 401ks, IRAs, and Roth IRAs offer important tax advantages and help accelerate our savings and investment programs, and that's what we're here to talk about today. Many of us are familiar with the terms, but we may not be taking full advantage of their options. Even if you think you're familiar with the terms, the rules governing each different part often are confusing and sometimes change over time. Today, we're going to try to provide some general guidelines. But don't worry about getting bogged down with the details. Much of this material in the session is available on the internet, either directly through the government resources as well as Wikipedia. We don't have the time to go into all the rules, but here's a basic tutorial. One suggestion before we get started: if you're an owner or a current participant in one of the plans we are about to describe to you and you're considering making changes, please consult your tax professional before finalizing any decisions. Okay, having said that, which one is right for you? We're going to start with 401ks first. Now, a 401k plan is the most commonly found plan in corporations that employ, any number of salaried workers. And when available, 401ks are popular for their double-barrel benefits. The first is that employee contributions are tax deferred, and the great kicker is found where employers make matching contributions to the fund. The employee elects to have a portion of weekly wages paid directly or deferred into his or her 401k account. This deferment is also known as a contribution. These mainly employer-sponsored plans, the employer can choose to match part or all of the employee's contribution by depositing additional amounts into the employee's account, or can simply offer a profit-sharing contribution to the plan. The most common option is the participant-directed plan. And here, the employee can elect from a number of investment options, usually an assortment of mutual funds that emphasize stocks, bonds, money market investments, or some mix of the above. Many of the companies in the 401k plans also offer the option of purchasing the company's stock. The employee can generally reallocate money among these investment choices at any time. Okay? Now we go on to the IRAs. An individual retirement arrangement is a retirement plan account that provides some tax advantages for retirement savings in the United States. There are a number of different types of IRAs, which may be either employer-provided or self-provided plans. These types include, you ready for this? Traditional IRAs. Contributions are often tax deductible. Deposit before tax or contributions are made on a pre-tax assets. That means that all transactions and earnings within the IRA have no tax impact, and withdrawals at retirement are taxed as income, of course, except for those portions of the withdrawals corresponding to the contributions that are not deducted. Does that sound like government work? Depending upon the nature of the contribution, a traditional IRA may be referred to as a deductible IRA or a non-deductible IRA. Okay? I hope we haven't lost you yet. Stay with us, because we're moving on now to the Roth IRA, and this has become a very popular item recently. The Roth IRA involves contributions that are made with after-tax assets. All contributions within the IRA have no tax impact, and withdrawals are usually tax-free, named for Senator William Roth, in case you wanted to know. The SEP IRA is a third type of IRA. With a SEP IRA, this is a provision that allows the employer, typically a small business or self-employed individual, to make retirement plan contributions into a traditional IRA established in the employee's name instead of into a pension fund account in the company's name. Okay, got that? Number 4, the simple IRA. I always like simple things. A simplified employee pension plan allows both the employer and employee contributions that's similar to the 401k plan, but with lower contribution limits and simpler, and thus less costly, administration. Although it is termed an IRA, it's treated separately. Number 5 is the self-directed IRA, and a self-directed IRA permits the account holder to make investments on behalf of the retirement plan. Now, it's important to remember that an IRA can only be funded with cash or cash equivalents. Attempting to transfer any other type of asset into an IRA is prohibited and disqualifies the fund from its beneficial tax treatment. So we don't want to start moving your homes or business assets into an IRA because that could become costly. Rollovers, transfers, and conversions between IRAs and other retirement accounts can include any assets. Okay? Again, you want to check with your tax professional before making any of these moves. Okay, here's something to keep in mind. The maximum for an IRA contribution in years 2006 and 2007 is 100% of earned income or $4,000, whichever is less, and that's for an individual under age 50. Okay, now if you're an individual age 50 or older, you can contribute up to 100% of earned income or $5,000, whichever is less. And for 2008 and year 2009, the limit is $5,000. Okay, got that? Okay, once money is inside an IRA, the IRA owner can direct the custodian to use the cash to purchase most types of securities and some non-security financial instruments. Wonder what that is. Some assets cannot be held in an IRA, such as collectibles. Those things like art, baseball cards, rare coins, those don't qualify. And life insurance, okay, can't do that. The rules at this point get quite technical, so we suggest if you have specialized assets like stamp collections and so forth, that you check with your tax professional. While certain types of investments are prohibited in an IRA, real estate is not one of them. As a result, real estate owned by an IRA can generate rental income and gain on a sale which escapes immediate taxation. An IRA may borrow money, but any such loan must not be personally guaranteed by the owner of the IRA. Although funds can be distributed from an IRA at any time, there are limited circumstances where money can be distributed or withdrawn from the account without penalties. Unless an exception applies, money can typically be withdrawn penalty-free as taxable income from an IRA once the account owner reaches age 59 1/2. Also, account owners must begin taking distributions at least the calculated minimum amount by April 1st of the year after reaching age 70 1/2. If the minimum distribution is not taken, the penalty is 50% of the amount that should have been taken. Wow! At the death of the account owner, distributions must continue, and if there's a designated beneficiary, distributions can be based on the life expectancy of the beneficiary. I hope you're still listening because this is really getting important. There are several exceptions to these rules. I knew you were going to ask. So we suggest that for those of you who are interested to watch closely, and in a future segment, we will focus solely on IRAs and Roth IRAs. Now, in contrast to traditional IRAs, contributions to a Roth IRA are not tax deferrable. Withdrawals are generally tax-free, but there are exceptions. An advantage of the Roth IRA over a traditional IRA is that there are fewer withdrawal restrictions and requirements. Transactions in a Roth IRA, including capital gains, dividends, and interest, do not incur a current tax liability. And what are some of the advantages? I knew you were going to ask. Well, we've got 6 of them. Number 1, direct contributions to a Roth IRA may be withdrawn tax-free at any time. 2, if there is money in the Roth IRA due to the conversion from a traditional IRA, The Roth IRA owner may withdraw up to the total of the converted amount without penalty as long as the seasoning period, which is currently 5 years, as long as the seasoning period has passed on the converted funds, okay? Number 3, direct contributions to the IRA may be withdrawn at any time with no tax or penalty since they've already been taxed. Number 4, assets in the Roth IRA can be passed on to heirs, unlike Social Security. Number 5, Roth IRA does not require distributions based on age. Finally, number 6, contributions may be made to a Roth IRA even if the owner participates in a qualified retirement plan, such as like a 401k, for example. Now, you ready? Who wants to know whether they're eligible? Pay close attention because we're just going to go over the eligibility rules. Income limits. Congress has limited those who contribute to a Roth IRA based upon income. Anyone can set up an IRA, but the limits of any contribution are based upon income, marital status, and other considerations. Wouldn't you leave it to the government to make it as complicated as they possibly could? So if you're considering setting up an IRA, a Roth IRA that is, you will want to check closely on how the limits apply to your particular situation. However, once a Roth IRA is established, the balance in the account remains tax sheltered, even if the taxpayer's income rises above any thresholds. That's important. These thresholds are just for annual eligibility to contribute, not for the eligibility to maintain the account. Now, to be eligible, you must meet earned income minimum requirements. In order to make a contribution, you must have taxable compensation, not taxable income from investments. If you make only $2,000 in taxable compensation, your maximum IRA contribution is $2,000. Let's go over to distributions for just a second. Direct contributions may be withdrawn at any time. Eligible distributions of earnings must fulfill 2 requirements. Number 1, the seasoning period of 5 years must have elapsed. And secondly, a justification must exist, such as retirement or disability. The simplest justification is reaching 59.5 years of age, at which point qualified withdrawals can be made at any time, in any amount, on any schedule. Also, becoming disabled or being a first-time home buyer can provide justification for limited qualified withdrawals. Wow, that was a mountain of information to consume, and we hope that you've had the chance to get a perspective on some very complex financial topics. The most important message that we can try to convey to you is to give you guidance on which of these tax-benefited plans fits your circumstance and needs. We want to thank all of our research resources at Google for our wealth of the latest facts upon which to check our memory. That's all we have for this session. I'm James Wagner for Professor It. Thanks for joining us.